Well, a quick thank you to Chuck and to Ron and to all the staff that make this possible. This is an absolutely fabulous event where we get to learn and grow and encourage each other. And I've been asked to speak on two topics. The first today is on sort of a macroeconomic outlook and overview, and then tomorrow dealing with finishing well and what it looks like from a legacy perspective to finish well as a steward of God's many resources. This is an interesting time to be talking about macroeconomics. There's certainly no lack of data to be looking over. And I'm going to argue that we're looking at something that is absolutely unique. The big story of this decade is that the system is being closed. The financial system as we know it, as channels of flow on Wall Street are beginning to narrow and investment options are being homogenized, cash in many parts of the world is being marginalized, eliminated, even criminalized, and the exits are beginning to close. This, under the guise of financial inclusion, is what is bringing the whole world into a digital and a tech-engineered utopia. I would also suggest that we're one social, economic, or political crisis away from a consolidated power structure. And that consolidated power structure is designed to bring you peace and prosperity. But I do believe that this will ultimately be at the expense of freedom, privacy, national identity, and even free expression. So today, we're going to look at a reflection back on the pre-global financial crisis period to give us a context for where we are. Then we'll look at and review the present state of the economy and the markets. And then last, we will do something of a speculation, anticipate what we can of the future. Why do we care so much about the future? Bondage for many people in the world is simply this. It's an inability to think beyond today into tomorrow, to envision a future, to see what is on the horizon. In the third world, this is because most people are concerned most about survival. In the first world, it's because we're distracted. We have consumerist pleasures, we live paycheck to paycheck, we live hyper-busy lives, and we have a very difficult time looking into tomorrow. So a move away from slavery and bondage begins with the space to think, to dream, and to create. In athletics, they say that you should slow down to speed up. So to see a future, to create a better future, at this home in India, where my parents spend a good bit of time, the director likes to say, the sign that we are winning is that these girls can think in terms of legacy. They can have a future and a hope. Now, understand, these beautiful women have lived unspeakable horrors, and their daily experience prior to life in this home, they were viewed as less than human. They were viewed as an object to be used and discarded. And so surviving for them is actually an accomplishment. To see a future and to live into it, to begin thinking in terms of legacy, even more of an accomplishment. So today, we want to talk about vision, because vision is everything. And I would argue that today, the economy and how we view things is being obscured. Our system is in fact being closed. And I want to open your eyes to ways in which you can more clearly see that. I'll demonstrate that again by looking at where we've come from since the global financial crisis. I want to look at a number of the sirens and warning bells that are going off within the markets today. And last, we'll look at those advances in technology, which are at the same time thrilling and terrifying. This week witnessed something of a historic nature. The first robot being given citizenship. Saudi Arabia decided to lead the charge, and technology, we interface with technology in new ways, some of which we're aware of, some of which are just underneath the surface. Daily, we have algorithms that read and anticipate our every decision, from the groceries we buy, to the gas stations we fill our cars at, to the sites that we visit most on the internet, so that in a nanosecond, customized marketing is crafted to connect retailers with our next penny. and with our next second in an effort to capture everything that we are. We are, too, an opportunity to be used up. So where we've come from obscurity to stardom, this gentleman, Alan Greenspan, began an era of central bank interventionism and raised the profession of central banker from the boiler room. Nobody really knew who or what central bankers did, but we've entered a new era of stardom where they occupy not only the corner office, but they are on the news and everyone cares about every breath they breathe. Under Greenspan, we also expanded the Fed's mandates to include management of the business cycle and asset prices. So again, we're really at an interesting place in history because we're witness in our lifetime to a shift away from capitalism. I'm not sure you're aware of this, but we've left capitalism and replaced it with debtism, which is nothing more than a migration from savings-driven growth to debt-driven growth. And that has huge implications. But it's been directed by our central bank community and the unified monetary policies globally. So through time, they've expanded their mandates. It used to be full employment and price stability. Now it includes price controls and business cycle smoothing. And in that process, we've had 40 years of massive credit expansion. And it's reshaped the free markets into a managed market environment. And there is to us, at least to me, that question of sustainability. How did it begin? In many ways, it began with this man, Alan Greenspan. He was the longest standing Fed chairman after William McChesney Martin. And ironic that Martin said on his way out, his sort of exit interview after he was leaving the Fed, he said, don't hire academics. They really don't know what they're doing. You have to have a few PhD economists down in the basement to run numbers for you, but make sure that you have people with experience. And I say it's ironic because today we have only PhD economists running the Fed. In fact, we have 700 of them running the show today. So from 1996, when Alan Greenspan said, look, we have irrational exuberance in the marketplace, and what was introduced is what was called the Greenspan put, where the market could not go down. They were willing to include themselves and prop up prices whenever there was a crisis. That intervention became the norm. We saw it in the late 90s, the Asian crisis. We saw it with the long-term capital management debacle in 98, which almost tanked the financial system. We saw it with the Russian defaults and when they went sour on their debt. Carry forward to 2000 and 2001, following the dot-com bust, he saved the world. He saved the world by reinflating the system using easy money policies. And truly, in that period of time, you could not hold back the tide of panic. But what did he do? He stepped in, and by inflating asset prices, which has become, as we said, the third mandate of the Fed, put a floor in the market panic. Fast forward to 2004 and 2007, following the dot-com bust, and after interest rates, he had dropped them 500 basis points, that is 5 percentage points, he engineered the next bubble. He engineered the next bubble in housing. And he handed the baton on to Ben Bernanke, his young protege, who was supposed to know everything about Depression-era business cycle management. When we removed gold as an economic foundation in 1971, we shifted to a world of unequal weights and measures. And frankly, it's been funny money and funny games ever since. So we now live in an era of funny business, and we're building new monuments of greatness. It's an interesting phenomenon to see, psychologically, sociologically, politically. I listened to Yellen just a few weeks ago proclaim that in her lifetime, we will not see another recession. And I get nervous. I get nervous when I encounter that kind of arrogance. I think certainly Scripture says something about pride comes before the fall. Looking back through time, all great monuments required a certain kind of serfdom or slavery to be built. In the past, it was captured and traded slaves. It was forced labor. In the present, it's debt servitude and taxes. And most of the modern world is, frankly, if you look around, it's not economical. It can't be afforded except using debt instruments. Slavery allows for the building of monuments, and the new slavery is far more appealing than a whip, but it is still a form of slavery. And we're signing up the next generation to pick up our tab. It's an obsession with limitless growth that we've taken to become the norm. We accept as the way it should be. And our obsession with limitless growth has compelled us to exchange the future, not only ours, but our children's, for the present. When the limits of debt-driven growth are reached and the system's complexity begins to weigh it down, then you begin to see a desperate ego-driven struggle. We created a Leviathan, known as government, and that Leviathan begins to fight for its life. This system, which takes care of us from cradle to grave, comes at a high cost. And if they feel that it is no longer economical to survive, guess what it devours in the process of trying to survive? You and me. They're refining a process, as we speak, of wealth extraction. And in the ivory towers, they call it financial repression. We'll talk about that more in a little bit. But I just would encourage you, please don't get caught 100% in and dependent on the system. You look at the great monuments, and you have humanity, which is obsessed with breaking the limits, with creating autonomy, with controlling destiny, our own destiny. And this is true of the angelic fall. It's true of the Babel temptation in every age and in every race. We will build and we will declare our greatness. Now, as believers, you and I know that all that is beautiful, all that is majestic is a gift from God. All that is creative and amazing is from his hand. The temptation is to claim responsibility just as Nebuchadnezzar did. Look at the work of my hands. And our monuments today, frankly, are no different. They're not economical except via the modern version of bondage. The Burj Khalifa, you see it here, 828 meters, 163 floors, the Taj Mahal, the pyramids of Giza. I think it's very interesting, just as a reflection, to step back and see something that's different in the young generation of millennials. They're discounting the need for stuff. They're content to consider tiny houses, looking for relational connection and shared experience over amassing junk. This is one of the big strengths, I would say, of the millennial generation, questioning what the old economy offered with all its ties and entanglements, and wondering if the newer generation, in fact, can do without. Paul Krugman, many of you may not know the man, but he was Nobel Prize winner in 2008. I think it's very interesting that he won in 2008. This is him in 2002 saying, to fight this recession, this is again 2002, following the dot-com bust, the Fed needs, Nobel Prize winning economist, remember, needs more than a snapback. It needs soaring household spending to offset moribund business investment. And to do that, Alan Greenspan needs to create a housing bubble to replace the NASDAQ bubble. And he did. Why? Well, because that's what you do in the mandates that they have of intervening and creating a better and brighter tomorrow. They got more than they expected. They blew up the world as we knew it. And we've done it again, folks. Post-global financial crisis, it's government spending that has filled the consumer gap in the economy. We'll talk about this in a minute. But lower rates, buying up assets, deficit spending bringing us to a $20 trillion mark, we have created a fabulous context for crisis. This is what we had, 2008, from subprime mortgages, exotic financial products, bankrupt states, shotgun weddings in corporate America, and all kinds of bail-ins that spread throughout the world. The only thing surprising about this is that it was a surprise. To the sons of Issachar, you look and you say, what times do we live in? What are the factors that we need to appraise? And what should we do about it? So people are panicking over counterparty exposure and liquidity risk and solvency crisis, and those were the days of AIG and Lehman and Bear Stearns, and these were the dominoes that were falling. No one asked if the system of debt-driven growth was problematic. No one asked that. The assessment was that there was not enough debt to drive growth even further. The conclusion was we needed more debt. And we're going to look at the IMF estimates in just a minute. The International Monetary Fund has some projections about where growth in debt in the United States and China have to be to continue to drive growth in the global economy. I think you'll find it very, very interesting. But what all of this forgets is the law of diminishing returns. As the burden of debt transforms savers into slaves with no more ability to cast a vision of tomorrow than those girls in India, living in bondage, you try to survive from one day to the next. I think one of the differences between us and them is at least we can have our 70-inch flat screen televisions. But what happens when these dominoes move from the financial and economic to the political and to the geopolitical? We see these four dominoes following significantly: a financial crisis to an economic crisis to a political crisis and ultimately to a geopolitical crisis. And where we're today is right in the middle of the political and the geopolitical. We see a swirling it around. When you look at the Catalan independence movement, you look at the upset in the Austrian election just in the last few weeks, the US election, which took everyone by surprise, the French election in which two established parties were thrown out in favor of someone with zero political experience and a new party that hadn't existed 1 year prior. The German election, an upset and a move towards the left, Brexit, all of these are examples of breaking with the status quo. And this tells us that we're between the political and the geopolitical dominoes. None of this is priced into the markets today. If you look at the stock market today, it looks like it's priced for perfection instead of political dysfunctionality. But I would argue that political dysfunctionality has not been greater in the post-war period. Since World War II, all of the established relationships that were there are actually being called into question. But no one seems to care. I'm going to work you through this chart. It's of the S&P 500, and again, just the role that intervention plays. The blue line is the S&P 500. You see it moving lower in value in the 2008-2009 timeframe, and then it spends the next 7-8 years moving to all-time highs. The red line is the federal funds rate. It's the cost of borrowing. And you notice that most of the interventions, whether it's lowering the cost of borrowing to zero, or if you look at the green bars, quantitative easing 1, quantitative easing 2, Operation Twist, quantitative easing 3, these are things that were driving prices higher. It wasn't economic activity that was driving prices higher. It was an intervention-driven boom. Since 2009, the collective central bank intervention has come to a total of $14 trillion. This is what central banks have today on their balance sheet. They created bad bank structures. They created special purpose vehicles. The kinds of vehicles, do you remember when Enron got in trouble for having off-balance sheet entities that they swept bad bets into and they just pretended they didn't exist? Well, the government has our special purpose vehicles, and they can do it. And that's what they did. They took toxic bets, swept them under the carpet where they still reside, orchestrated every version here of financial market triage, and the one focus they had was this: get the consumer spending, get it in their heads, bring back peace and calm, get them doing their duty, getting out there and spending. Why? Well, I mean, don't you know, 70% of our economy and economic activity is consumer spending? So when the consumer backs away, the economy really goes into the tank. Now, we find ourselves at the end of the line. We've begun to raise interest rates, and we've begun to see a slowing of M2, monetary supply growth. That's not good. It's not good because what it implies is that everything we set in motion to fix the system and prop up asset prices can be reversed in the process of raising rates. You have the European Central Bank, you have the Fed, which are suggesting quantitative tightening now, selling assets that they bought to save the system. And that would imply, if there is some sort of symmetry, that we see a decline in prices. We're talking about a decline in real estate prices, bond prices, stock prices, et cetera. Japan and their intervention in the markets, we mentioned at lunchtime, 70% of equity ETFs on the Nikkei are owned by the Japanese central bank. This is not a market anymore, folks. This is not a market. They own 40% of all debt. In the United States, the US government and Fed are significant holders of mortgage-backed securities and treasuries. in this recovery period, we have seen, and again, recovery, when you look at asset prices, we've had the recovery. But we've seen no significant GDP growth. It's the weakest recovery in post-war history. No significant money supply growth. And in fact, it's just beginning to fade as we raise rates. All we've had is asset price inflation. Now we're entering a period of quantitative tightening, the opposite of quantitative easing. And again, we just wonder, you have a leveraged system. If there's any symmetry at all in this, we may have a real surprise. This is cautionary. What am I suggesting? I'm suggesting that there's some danger in the system. And I don't care. It's ultimately not about central bank causality and what they do or don't do. It's about the mood and sentiment in the marketplace. And what I'm going to describe for you in just a minute is bubble dynamics. Dynamics that would imply it's as good as it gets. It's never been better. Never, ever, ever been better. And I'm going to provide for you some evidence that I think will support the fact that the economy's in recovery. Happy days are here again. And you have absolutely nothing to worry about. Except that when you have nothing to worry about, that's when prudence usually suggests that you think twice, you look twice, and you engage in risk mitigation in a very different way. I'm going to read a quote by Richard Fisher. At some point you cross the line from reviving markets to becoming the bellows fanning the flames of the booming and bubbling. That's what Neil Irwin writes about. I believe we have crossed that line. Richard Fisher was head of the Fed in Dallas, so the Federal Reserve Bank of Dallas, and he retired shortly after making this comment. He retired in 2014. He felt like the markets were already past that line. They were bubbling over, and that the Fed's activity pushing up asset prices was in 2014 dangerous. Roll the clock back. That was the Dow 5,000, 6,000 points ago. Where are we at today? Where are we today? I want to start with the good news. This chart shows you the blue line, which is increasing household net worth. It's never been higher. This is the highest net worth figure we've ever had. That's because stocks are up, and bonds are up, and real estate is up. And guess what that red line is? It's interest rates. Interest rates are down. The cost of capital has a very significant contribution to make. Stocks generally rise in a declining interest rate environment and generally fall in a rising interest rate environment. Why? Because the cost of capital squeezes profitability and margins. Bonds, same thing. Interest rates go up, it's just like a seesaw. When interest rates are moving higher, bond prices go lower. We now have bonds, get this, do you know where we're at? Just for perspective's sake, interest rates are near a 5,000 low, 5,000 year low. So what does that put bond prices at? That's right, on the other end of the seesaw, the highest they've ever been. Well, actually they were the very highest last June, June of 2016. So 2014 is when the Dallas Federal Reserve makes this comment. We've already crossed the line. We've crossed the line. That's when he made those remarks. And we've been on thin ice since then. But the asset price party, it will continue until the music stops. Enjoy it while you can, but don't think for a minute that the current trajectory can be maintained. We have net worth improving, and I love the chart. But just as reducing the cost of interest drives up asset prices, increasing the cost of interest, rising interest rates has the opposite impact, bringing asset prices right back down. You've got to get that into your head. Government debt today, as a backdrop issue, is about 110% of GDP. It's pretty well established that if you go above the 90% level of debt to GDP, you're moving into a realm that is destabilizing. And if you maintain that level for more than 3 years, you will reduce GDP growth by at least a third. We've been above that level for 6 years, and our debts are continuing to rise. And you might say, well, but we've got tax cuts coming, we've got a new administration coming, this will be great. Right, tax cuts are debt funded, same theme. We can do anything we want as long as we have a line of credit. And it's very different than the last periods of tax cuts. Do you remember 1981 and 2001? when those administrations were reducing the tax burden? Well, today we have falling velocity of money. Then we had an increasing velocity of money. Today we have falling monetary supply growth. And we started those periods of tax cuts with interest rates at very high levels, which gave the Fed the opportunity to lower rates and accommodate using interest rates as a tool. We can't do that today. I mean, we're talking about 500 to 900 basis points lowering of interest rates in those previous periods of tax cuts. We don't have that latitude today. We're at 1%. We're at 1%. You can't theoretically get much lower. We'll talk about theoretically getting a whole lot lower in a minute. The SNAP program is our food assistance program. In 2017, we're at 44 million people participating. In 2007, it was 26 million. So we have had a recovery in asset prices, but there's a lot more people in middle America that are saying it's not quite working for me. I don't have enough money to make ends meet. 46% of Americans can't cover a $400 emergency drawing from savings. They don't have it. 78% of Americans live paycheck to paycheck, which is double the number since 2006. Did you get that? 78% living paycheck to paycheck, and it's doubled since 2006. So recovery for whom? This is why we have political turmoil here in the United States. This is why we see that as a growing trend globally. It tells you that there is a disconnect from the economic experiences of the rich and the rest. And yes, there are a number of positive economic indicators suggesting that the consumer is back in business, but there are limits to that as well. Let's go there. Income growth has been paltry. GDP growth is driven primarily by consumer spending. We talked about that earlier. It's currently 68% of GDP, consumer spending. Right now, any of the improvement we've seen in consumer spending has come from one part savings reduction, one part credit expansion. That is more borrowing and one part income growth. To see sustainable economic activity and growth, you need to see three parts income growth, and we're not seeing that growth in incomes. Incomes in real terms, coupled with a debt-laden balance sheet, keep this economy from its full potential. U3 versus not in the labor force. I'm going to skip ahead and read this quote to you. 1996, the St. Louis Fed had an interesting internal conversation. It went like this. Underutilization of labor may be more pervasive than the unemployment rate suggests. Some people searched for work in the last year, but have recently quit searching. These marginally attached workers include discouraged workers, people who quit searching because they believed further search would be futile. They are considered not in the labor force. But are they really less unemployed than the workers who have not yet given up? See, when you look at the decline in U3, the unemployment number, you think, well, this is fantastic. We're at 4%. And yet the not in the labor force number is at all-time highs, 95 million. 25, almost 30% of the US population is no longer in the labor force. And so what is it exactly? Is it 4.2, 4.3%, the unemployment number, U3? Or is it convenient that many people who are unemployed and underemployed simply aren't counted in the rolls? So the rise in populism we see globally, not as a coincidence, but again, Brexit, Catalan, the French elections, Austria, Germany. The last time we saw this much populism was in the 1930s when communism was in vogue. Right? So there's a backdrop here of discontent, Meanwhile, if you go to the markets, there are signs of bubbles almost everywhere. And I want to look at some of those psychological markers with you today as we look at sort of what it looks like for the markets. Current tense, we talked about the past and what has brought us here, debt-driven growth, a transformation of the business model. Capitalism, what is capitalism? You save so that you can invest your capital, and you grow the economy through saving and investment of capital. We left that for debtism. Now, growth is driven by an expansion in debt. The best economists that I read assume that if we don't have an increase, net of inflation of 2%, debt growth per year will be in a recession. They're just assuming we have to have it. It's just a part of everyday life, we have to have it. I would argue differently. but I want to talk about these market dynamics and what it looks like to be in a bubble phase. When something is not really bubbling up, that's the stealth phase. Nobody cares. Maybe it's smart money, maybe a few people notice, but you begin to see awareness grow. And in that awareness phase, institutional investors step in. Wall Street begins to take an interest, whatever the asset class may be. The final phase is a mania phase, and the mania phase is where the man in the street steps in. The mania phase is where you move towards public interest and public investment. Wall Street's already taken their positions, now the public is coming in, and it's greed, and it's delusion, and it's a new paradigm. And do you know when it ends? It ends when the last buyer enters the room. It goes, and it goes, and it goes irrationally until it ends. And it's just a body count. You run out of new dollars coming into any market, and the price stops going up. For prices to go up, you have to have new dollars come into the market. And when you run out, that's when you begin to see a reversal. There's denial initially. This can't be happening. We're in a new paradigm. We're buying a value. And ultimately, you see fear grip the market, capitulation, and despair. What would it take for me to convince you that we have bubble dynamics today? If I gave you 3 examples, I feel like a lot. If I can find 10 people, can we fix this mess? What about 1? I'm doing the opposite math. If I gave you 3 examples, would that be compelling? How about 10? How about 20? How about 30? I'm going to whip through these 30 examples, and I'm going to assume that you're buying the videos so that you can look at these on your own time, okay? Because you're going to have to buckle up. I'm going to stop and give you 3 or 4 visuals, charts that will help you see what I'm talking about. Overvaluation in every asset class, a bull market in everything, a bubble mania in virtually everything. We'll look at those charts in a minute, but I'm just going to whip through this list of nearly 30. And again, for those of you who are viewing, you can press pause. Dozens of sentiment indicators are at record highs. Dozens of debt-related stats are at record levels. We have manias in the FANG stocks, that's Facebook, Amazon, Netflix, Google, which is now Alphabet, and the cryptocurrencies, which just a reflection of speculative mood. Low dividends indicate excessive valuation in stocks. Stock market relative to GDP, that is the size of our economy, is historically high. Cyclically adjusted PE, second highest ever. S&P price to sales, highest ever. Commitment to pension fund cash, never been lower. When pension funds are all in, that's what that means. When pension funds don't have anything in cash, it's because they're fully invested, right? Commitment to stock funds versus money funds. If you go back to 1982, that was the beginning of a bull market or the end of a bear market. Sentiment was terrible. The ratio of money market funds to stock funds was 1 to 5. Now it's 5 to 1. It's the exact opposite. AAII stands for the American Association of American Independent Investors, lowest cash levels since the late 90s. Average stock manager now has 102% allocation to stocks. That is borrowing to buy a sure thing. Massive artificial buying by shares by their own companies, reducing the outstanding shares, creating an artificial buying dynamic, boosting prices, hundreds of billions of dollars per quarter. Market vein bullish consensus above 70%, bullish consensus above 70% for the 3rd time in 20 years. Note when those other 3 times were. 97, late cycle phenomenon. 2007, late cycle phenomenon. 2017, I would suggest it's late cycle phenomenon. University of Michigan polls stocks to rise over the next 12 months. That was the question asked. All-time high, yes, in the history of the data. Volatility index is at a 25-year low. The Michigan survey on current economic conditions, 2nd highest on record. Record moves from active management to unmanaged index investing, record bets that volatility, even though it's at historic lows, is going to continue to go lower. Margin debt at all-time highs, $551 billion. We'll come back to that and hang out on that, look at the chart in just a minute. Mutual fund and ETF investors, lowest level of cash on record. Translation, ever. Bull versus bear funds, highest ever ratio favoring bullish funds. Fewest bears among newsletter writers since 1966. Yields on debt, near the lowest in 5,000 years. Yes, that means that prices are the highest in 5,000 years. The debt market bubble is huge. The quality of debt continues to deteriorate while the price and yield reflect complete indifference to risk. These are all the things that I would say, if you're concerned about your 401k, if you're concerned about your savings, if you feel like you've just been given a windfall in the stock market, in the bond market, in the real estate market, appreciate that it's as good as it gets. It's as good as it gets. And usually when things feel great in the marketplace, that's usually when you should be very, very cautious. 85% of institutional loan issuance at present is covenant light. Low to no collateral on very easy terms for the people who are borrowing. It's insane. It's this kind of thing that was happening. Do you remember the subprime? This is the issue. You start compromising on quality. You start ignoring risk. It's happening all over again. Highest levels of investor capital in junk bonds, 400 billion at present, only higher once in history. Here are the positives. And again, how are positives negative? Well, because the markets run in cycles. So usually things are great just before a market downturn. Employment figures, okay, great. Household net worth, great, never been higher. Bigger skyscrapers than have ever been built before actually usually comes at the top of a market. People start getting bold and ambitious, and they've got access to cheap money, which means they can dream big, beyond what they could normally. There's no such thing as a budget when you can borrow at 0%. So you've got that, you've got more horsepower in cars. And again, these are indicators of where you're at. If you were looking at society, looking at psychology, looking at sociology and saying, how do I know where we're at? If you were a son of Issachar and you were looking for signs of the times, you might not think that muscle cars tell you something, but they absolutely do. Expensive foods? You can go to the Westin in Manhattan and pay $1,000 for a bagel. Oh, white truffle cream cheese, and you've got gold leaf. You wouldn't pay $1,000 for a bagel? Do you know when there was another hotel that offered a similar bagel? 2007. Right? They took it off the menu shortly thereafter because it only happens when people are just freewheeling with cash and thinking to themselves, it's never been better. It's never been better. The largest move in any asset in the history of the world, and the participants would say, oh, but it's not a bubble. Bitcoin, 600,000 times move in Bitcoin since 2009. And some would argue it's still a bargain. I'm not here to say yay or nay on the cryptocurrencies. I'm just telling you that when you have those kinds of dynamics in place, they are supported by bubble dynamics. And those bubble dynamics are, as we've illustrated, supported by debt, almost an infinite amount of debt. European junk bonds. What does this tell you? Okay. When you see interest rates in the 20 to 25% range, it tells you a lot. When you see them, because there's panic in the marketplace, people are selling the asset class, people don't trust the person they're loaning money to. Are you telling me that low-quality borrowers in Europe justify 2% loans? The lowest quality borrowers in Europe are getting money at 2%. They're able to finance their businesses for less than the US government. Tell me if that's realistic. Is it realistic? I love this. History tells us that the next cycle is going to be painful. And that's because risks are being ignored. They're being ignored. They were ignored in 1999 and 2000. They were ignored in 2006 and 7. But this is information that I think is invaluable to you. We talked about margin debt, 551 billion. Here we are. If you look at the blue line, that's the S&P 500. If you look at the red line, that's borrowed money, that's margin debt. You can go up and you can push prices to unnatural levels, particularly when you're borrowing money, but guess what? You've got to pay that money back. You've got over $500 billion that has to be paid back. In fact, you have to clear 10% in terms of a positive speculation using borrowed money just to break even. You've got your borrowing costs, 6 to 7%. You've got your taxes to pay on the gain. That just gets you to break even. So if a trade begins to move against 550 billion, are they twitchy to get out? Are they twitchy to sell? Oh, absolutely. This is the kind of thing that represents like the backdrop for market panic. This is what you had circa 1987. We mentioned the cyclically adjusted price-earnings ratio, also called the Shiller PE. It's the second highest in US history. What it implies is that if you're sitting in stocks today, you can expect basically a 0% return over the next 10 years. Now, split it up any way you want. Maybe it's a 50% hit next year and it comes back, but at the end of a decade, you know what you'll have to show for your investments 10 years from now. Great studies. I'm happy to give you reading on this. Some folks out of England have done sort of the definitive work on Tobin's Q and the cyclically adjusted price-earnings ratio as the best measures of value in the stock market. But what it is telling you, what this is telling you, is that investing in stocks today is a mug's game. Is there more upside? Sure, because bubbles can go higher and prices can go higher for no good reason. But easy money does that. It floats all boats. The margin numbers have me very worried because that is something that can turn on a dime. It tends to turn on a dime. Here's something that should keep you up at night. Price to sales ratio. Do you realize that we've had a decline in revenues and sales on Wall Street? I mean, not Wall Street, S&P 500 companies for 2 years. And yet their share prices continue to move higher. Does anybody here own a business, manage the business? Okay, what happens when your revenues are off? Year after year, quarter after quarter. Does that send a message to you that something needs to be fixed? And yet investors are moving headlong into the market, ignoring that the price to sales ratio has never been higher in US history. And in fact, the fundamentals driving revenues and sales for corporations have been in decline for 2 years. But you only care about price. And you need more than price in a managed and controlled environment. I could calculate the motions of the heavenly bodies, but not the madness of people, Sir Isaac Newton said. He was an owner in the South Sea Company. He made money in one of the greatest speculations of the 18th century, sold, profited $7,000, and then watched the price continue to go higher. He couldn't believe it. He thought he sold at a high. He got back in with 20, lost it all. $20,000 in the 18th century was the equivalent of $2 to $3 million. You don't make that back in a heartbeat. From that point forward, he would not allow anyone in his life to ever mention the South Sea Company. So here's the X factor. The IMF says that China is going to double their debt from 27 trillion within their financial system to 54 trillion by 2002. We are either on the cusp of the biggest asset boom in history based on that record credit expansion, or the biggest global bust immediately around the corner. And it's just a grand confidence game. It's a big confidence game. If it works, it works. And they're willing to gamble it. They're willing to gamble it. 27 to 54 trillion, that's by 2022. The US and China together, well, let me just look at the US first. The estimates for the US is that in the same time frame, we'll grow our debt by 18 trillion, bringing us to a total of 84 trillion within the system. Okay, so bring that together, and what does that mean? Between now, if you say, Niall Ferguson liked to call it Chimerica, the combination of China and America. Bring those two economic expansions together, or debt booms together, you're talking about $45 trillion of credit created between 2017 and 2022. You're either going to see the stock market triple from here or get cut in half. And if it triples from here, you understand what basis it's moving on. We've figured out what the old alchemists couldn't. It's all about debt. You don't have to turn dust to gold. You just need to remove gold from the equation altogether and move to an entire credit and debit system. Here's my concern, and this is where we're going next. On the other side of a bust, I think the Fed and the Treasury have more invasive tools in mind. So I want to talk just briefly about a move towards a cashless society. In the midst of crisis, we want calm. And government is always willing to give us what we want at a price. Before we talk very much about the cashless society, just on a lighthearted note, Uber does not really mean large. Kickstarter in the modern era has nothing to do with bicycles or motorcycles. And Venmo, for those of you who know the app that allows you to transfer money from one person to the next, you guys could be transacting business right now. $5 to you, $20 to you, all digitally. Venmo has nothing to do with your VIN number. Michael Woodford and Ken Rogoff are two guys leading the charge towards a cashless society. You should read this book, The Curse of Cash. He makes the case that it's dirty, that it's evil, that it's unnecessary. I'm going to cut to the chase. What he wants is a system where he can control all of the money within the system. And they can't do that when there's cash. When you protest and aren't going to comply with what they want you to do with your savings, you can put your money in the mattress. But not if they close the system. And what they're creating is an argument for closing the financial system and moving to an entirely debit and credit system. Interest in prices, Michael Woodford is borrowing from two dead economists, Keynes and Knut Wicksell. And he's basically saying, look, we can control interest rates, and if we have to, we'll take interest rates negative. And yes, that extracts value from savers. Imagine having $100,000 that you put in the bank and you have a negative return on it instead of a positive return. They've created the case. Woodford's at Columbia, Rogoff's at Harvard, and they've created the case. Just close the system and you can do whatever you need. These are the effective tools that we need to manage towards greater success. What they're really saying is, I can't give up on a failed idea of perpetual growth driven by debt. And rather than check my ego at the door and see if those ideas were misengineered in the first place, let's lock down the system and just continue going as if we know what we're doing. So you have, in this context, cash being criminalized. Why? Because then you get to consolidate all of your transactional financial flows. And what does that allow for? It allows for greater scrutiny. It allows for, in an era of big data, the opportunity to look at everything, to judge what is happening, to predict what's going to happen next. Some of that might be for fun and profits, but some of it might have ulterior motives. I think history suggests that today's benevolent dictator, whoever or wherever they may be, they don't stay the same. They don't remain in power. And the apparatus which under one rule is kind, under another is cruel. So moving towards a cashless society, what you see is the goal of globalists moving all payments and transactions to an electronic base. This allows governments to track and record all your transactions globally. All money locked into the financial system allows for what they've already experimented with in Europe, which is running rates at a negative level. They've already done it. They've already done it. That's what we talked about earlier. Financial repression is the 10-cent word that the academics like to use for extraction of value from your savings. Now, they can do it through normal legislative means, but isn't it a little controversial to raise taxes? What if they can raise taxes and they don't have to ask your permission? What if there's no political ramification because they've done it in a very sophisticated way? In language, financial repression, which doesn't sound that bad. In fact, it sounds kind of boring. But like taxes and inflation, this is another method for value extraction, and it's just not politically sensitive. Nobody gets it, so they can get away with it. For the sake of convenience, we've commoditized ourselves. We are what is bought and sold. Your profile, your habits, your quirks. My concern is not with cryptocurrencies, but that the blockchain technology which is being introduced is the perfect digital footprint for all assets on the ledger. Who, what, when, where, why. You have been, at this point, converted into market fodder for mass consumption. I hope it's only that. I'm going to just adjust this quote slightly. Under a scientific substitute, this is Aldous Huxley, under a scientific substitute technological dictator, education, substitute convenience, will really work, with the result that most men and women will grow up to love their servitude and will never dream of revolution. The nature of psychological compulsion is such that those who act under constraint remain under the impression that they're acting on their own initiative. The victim of mind manipulation does not know that he is a victim. To him, the walls of his prison are invisible. He believes himself to be free. That he is not free is apparent only to other people. His servitude is strictly objective. So we love to go online, and with it comes problems of network insecurity. And with that comes the solution. Problem is insecurity, and we can make everything safe for you using biometric identity. If you like the new iPhone 10 as an example, you can have your face scanned, and that serves as the means of identifying you and attaching you to that technology. In China, it's becoming very common to authorize payments using that same facial recognition technology. The cashless society has dramatically accelerated since last November. India is the biggest cashless laboratory experiment. November 8th, while we were worrying about the election, they had 86% of their cash called in. If you weren't in the banking system, you either lost your money, 400 million Indians lost everything, or were scrambling to get your cash in as quickly as possible. Of course, Prime Minister Modi said it was to fight black money and tax evaders and whatnot. But it's interesting, we served this up for them. It was the US government, USAID, which created the entire implementation plan and gave it to them. And if you can do anything in India, you can certainly get it done in the first world.
Thank you for inviting me to participate in your forum. I wish I could be there in person to take part in the discussions you'll have over the next few days. If we were building a financial system from scratch today, we'd do it on a digital platform. Digital can lower the cost of a range of transactions by as much as 90%, providing nearly universal access to innovative financial products and services. Unfortunately, we don't have that luxury of starting from scratch. So we have to show not only the vision to plan for this better digital future, but also the wisdom to manage a secure transition from the current system. It's a big responsibility, but with more than 2.5 billion people not able to get at formal financial services, the opportunity compels us to do it. Poor people do have assets, their intellect, their labor, their savings. The problem is that they don't have financial tools to capitalize on these resources. They're trapped in an inefficient cash economy that robs them of opportunities to insure themselves against risk, invest in their productivity, and ultimately to help lift them out of poverty. The vision, the Alliance for Financial Inclusion, laid out in the Maya Declaration is a paradigm shift in the way the poor are able to approach life, seizing control of it rather than trying to manage it. Success will require a paradigm shift in the way we conceive of the financial system, from cash-based to digital. Paradigm shifts are hard work. Individually, as regulators, and together as members of the Alliance for Financial Inclusion, you will have to confront problems.
Financial inclusion is the buzzword. Financial inclusion is something that, it sounds good, it's generous, it's philanthropic, and who's pushing it? The globalist establishment, the US government, the European Union, mega banks, Barclays and Citigroup, the Ford Foundation, the Bill and Melinda Gates Foundation, United Nations development programs, credit card giants like Visa and MasterCard, and it's being implemented in India. Test cases are already there in Australia. Sweden is almost entirely cashless now. If you're begging on the streets, you can take a credit card and actually receive payments on your smartphone from somebody who just gives you $5 instead of handing you a bill. It's fascinating. Wait, I love Gary Larson. Wait, listen to me. We don't have to be just sheep. I started by suggesting that a lot of this funny business started when we removed gold and silver from our monetary system and introduced a new system of unequal weights and measures. You personally should reset the foundation. And we may not get that done as a country. In our Q&A earlier, we talked about the possibility of reintroducing the gold standard, and I don't think that's going to happen. But I think as an individual, you should establish a firm foundation for your finances. Why is this dime worth 13 of today's dimes. Those of you who have talked and visited with our colleagues know that something has happened to our money. And it is this. 1913 was the creation of the Federal Reserve. 1971 was the disconnect between our currency and anything real. And since then, we've gone from money printing, which everybody did through time, to now credit creation on a scale never even imagined. Thus, it takes 13 of the new dimes for the old one. And it is a little bit like the frog. Relax, you'll be fine. These are some things that I would suggest about gold. To restore on a personal basis gold as an economic foundation, I look at this, and we'll do this tomorrow as an exercise, looking at the legacy that you want to leave. There's lots of problems and macro issues, none of which started as macro problems. They were all micro in nature. Now they've just aggregated into things that require massive amounts of attention. I don't have any big picture solutions for you, but I do have micro level solutions, whether that's having dinner with your family more than once a week, whether it's going on a walk with your wife and holding hands more than once a week. If you want to restore the foundations of family, if you want to create legacy, if you want to manage resources of a tangible nature, whether it's physical resources or an intangible nature, life, love, family, identity, it starts with the micro. It starts with the little things. Gold has always been a store of wealth. It's been a means of value transfer. It's been an asset which is outside the financial system. It is very conveniently negatively correlated to financial assets, and since December 2015, reemergent into a bull market. What we have today are illusions of wealth, actually built on debt. And we have illusions of freedom, actually the establishment of bondage, slow but sure. And as we move towards the last stage of this credit experiment, I recommend that you build a firm foundation for your own finances, one that can weather any storm. If you ever wondered what $10 million worth of gold looks like, that's it. The Romans took their currency and did the same thing. The denarius was whittled away under the system's complexity and the cost of maintaining an empire which continued to grow and grow and grow. The Leviathan was bigger and bigger and bigger. And collapse for the Romans was not all at once, but a gradual deterioration of the foundations of their greatness, and then all at once. Like Ernest Hemingway says, how did you go bankrupt? In two ways, gradually and then suddenly. These simple things I would do immediately. And I would ask you to think about those 30 things which are indicators to you of exactly where we are. And I'm going to start with what I think is the most important. Reduce risk in your portfolio. If you are a steward of wealth, recognize that it is not yours. It is not yours, it's God's. And if you're holding on to it, because something inside you just loves making money, and the last bit of an uptrend in the stock market has you wanting just a little bit more, I've given you 30 things to think about that recognize for anyone in my industry, Educate yourself. Join us weekly at McAlvanyWeeklyCommentary.com. We've done this for 10 years. Chuck was on our program a number of times, and I'm sure thanks to you, those were our best viewed shows, nearly 200,000. Reduce debt aggressively. Raise cash. You want a nice cash cushion. And hedge that cash cushion, because yes, the Federal Reserve is destroying it gradually. Hedge that cash position and your financial market exposure, stocks and bonds, with gold and silver in a portfolio. This is something that Don's never done, but he asked me to do it to honor Chuck. He wants to give every one of you 6 months of a free subscription to his newsletter, McAlvany Intelligence Advisor. It's one of Chuck's go-to letters, and if you go to newsletteroffer.net, you can have 6 months for free. It is our approach to understanding the world in the big picture and getting real practical. My parents live in Asia. They're there 90% of the time working with 9 or 10 different orphanages. And he still takes about 100, 120 hours a month to write that letter. It's a fantastic big picture view once a month as to what is going on. If you want something dialed up, the weekly commentary is there every week. It's free. You can listen to the weekly commentary. Kevin, my colleague that you can meet here, does that with me, has for the last 10 years. This is so important. This is so important. And I know we're just talking about money today, which in the grand scheme of things is not so important. Tomorrow we get to talk about the stuff that really matters, the intangible side of legacy. But to the degree that you see yourself as a steward of God's wealth, reduce your debt aggressively, raise cash, hedge what you have, reduce risk in your portfolio. Please go through back through that list of 30 things and look at each one. I'm happy to have a conversation with you about any of those. I look forward tomorrow to talking about the things that I'm probably even more enthusiastic about, a critical aspect of legacy stewardship, finishing well. Thank you very much.